Everyone knows retail has been absolutely crushed recently. If you look at just a few retailers here, you have JCPenney down 80%. Sears is down another, 86%. And they've all been getting absolutely crushed by Amazon. Amazon has pretty much found a way to bring everything online. People are a bigger fan of that than they are to going to a store. So that makes complete logical sense that Amazon would be crushing retail. And even big retail players like Target are hurting, down 32%. So pretty much the entire industry has been damaged significantly by Amazon. And of course, since retailers are struggling and a lot of them are going to be potentially going bankrupt, that would make the REITs that are renting these retailers, their buildings, also struggle. So there's pretty much been an entire industry-wide sell-off in retail and retail REITs. So if we look at, this is a ETF that covers real estate. And so it's down significantly recently, and then even more so down from highs of 86 up here. So this is an iShares ETF. It's the same thing with the Vanguard REIT ETF. There's been just a massive industry-wide sell-off. And so while I wouldn't touch any retailers or most retail REITs, I think that one company in particular has been sold off because of this that isn't at risk of getting crushed by Amazon. So that's a REIT called Realty Income Corporation. And if you look, they have a really nice dividend yield, 4.52%, and that's a monthly dividend. So that's great because you're getting paid every month instead of every quarter. And they have a solid price to book of 2.1. And ignore the price to earnings. I'll go into valuation of REITs more a little bit later in the video, but you don't want to value a REIT with their price to earnings because they're constantly depreciating the value of their buildings, and that's going to come out of earnings, even though the value of real estate is normally appreciating or at least maintaining steady. So what you do is you use funds from operation instead of price to earnings, pretty much. So instead of earnings, you use funds from operation, and that adds back depreciation into their earnings. So if we look here, they also have very low debt in compared to the industry, and that's crucial for a REIT because they're required to pay out 90% of their earnings in dividends to their shareholders. So it's oftentimes difficult for REITs to grow. So they have to be able to take on debt to finance new building acquisitions. And since they have low debt, that will make it a lot easier for them than it would for other REITs. So this is from their most recent investor presentation. And so this really highlights their strong dividend growth and just constantly paying a dividend ever since they were listed on the New York Stock Exchange in 1994. And they've raised it every single quarter since then. Did not cut it in 2008, continued raising it throughout 2008. So that speaks to the stability of their dividend. And then over here, this is their top tenants. So if you look through here, it's Walgreens, FedEx, Dollar General, LA Fitness. You got theaters, Super America, CVS, those kind of things. And so I don't think that those are the type of businesses that are going to get put out of business by Amazon. If you look at Amazon, it's taking out specialty realtors, JCPenney, Sears, all that, but it's not taking out some of the discount realtors and some of the more service-based real estate. So if you look at AMC Theaters, for example, there's no way for Amazon to put AMC Theaters out of business because you need a movie theater for that. And then the same thing is true for Super America. You're going to need to get gas whether there's Amazon or not. So they're very safe in terms of clients that aren't going to get put out of business by Amazon. And then as you see here, 9 of their top 20 tenants are investment grade. So that pretty much means that they are considered safer to loan money to. So here is just another way of highlighting their highlighting the diversification in their real estate portfolio. So they have drugstores, convenience stores, dollar stores, health and fitness. So if you look at the common theme through all of them, it's cheaper stuff and stuff that you need right away. So like quick service restaurants, for example, Amazon can't knock that off. Amazon can't knock off casual dining. They can't knock off theaters. I think they're going to struggle if they try and knock off drugstores or convenience stores because a lot of it's service oriented. So I think that they are safe on that front. Moving on, they've had a very, very steady occupancy rate in their buildings. So if you look this most recent year, for the first quarter of 2017, I guess, 98.3% of all of their buildings were rented, which is really significant. And if you look at their track record all the way through 2007, 2008, it was always above 96% occupancy, which speaks to their stability as a company, even through tough economic times. All right, and then so here is their new building acquisitions in 2017. So they've bought 60 properties in 2017, and the average lease term on these properties is 16.4 years. That means that they have locked in those 60 buildings on average in contract for 16.4 years of guaranteed income from those, unless the person they're renting to goes out of business, which is unlikely. So that's another very safe aspect of their portfolio. And then on this slide, this is on their website. It says that currently their average lease term is 10 years. So that means for most of their buildings, they're not going to need to renegotiate a lease. They're not going to need to find a new tenant for 10 years. So that's really significant as well because it's long-term and stable. All right. So this speaks to their cost of debt, which, like I said before, cost of debt is crucial to have a low cost of debt for REITs because they need to finance a lot of their growth with debt. So if you look here, their average debt rate is 4.15%, which that's very, very cheap if you look at the debt rate of a lot of other companies. And so that will really help them grow because they're able to get debt at a low rate, which can allow them to invest in safer tenants. Because if you're getting a risky tenant, then that tenant's going to pay you more. But you only need to do that if you have a high rate on your debt. If the rate of interest that you're paying on your debt is low, then you can find safe tenants that are going to be paying you lower rent. But since you have a low debt, you'll still be making a profit. So that's really crucial. And then also back to their low debt rate of, I think it was 0.8 debt to equity ratio. That's very good because if you look at where we are in our economic cycle, we've been in an expansionary period for 8 years. So eventually, I think in the next 3-4 years, we're going to have some kind of a pullback. And during those pullbacks, real estate gets a lot cheaper. And so with a low amount of debt, they can afford to take on debt to buy real estate when the prices go down, which I think will be a key to their success if we face a recession. And then moving on to here. So this is their free or funds from operation per share. It's $3 to $3.06 per share, and that's a 6.3% growth, which is really nice. They've been maintaining strong earnings and funds from operation growth for quite some time. If we look here, this is their average funds from operations over share. So that's carried annual growth rate, I think. And it's that they are the dark blue compared to other REITs, and they've outpaced them every single year, and they've maintained steady above 5% almost every single year. So they've had really strong funds from operation growth. So when valuing REITs, what you're going to look for is normally high teens to low 20s in funds from operation per share, over share price, sorry. So if you look, they have, we're going to say $3.03 per share funds from operation. And if we just go to their chart right now, we'll see that they are $54 per share. So we can just do 54 divided by 3.03, and that's going to get a 17.8 is their multiplier on their funds from operation, which that is pretty cheap, especially for a company that has had such a successful track rate, 24 years of raising their dividend, which is really, really speaks to the fact that the company is managed very well and that the company will continue to pay a dividend. So we're just looking at the chart here, and they have gone down, as you can see, from 62 down to 54. And I actually bought in, I think it was around 54.50 per share. recently. I've been long in Realty Income since 2014, actually. So my average cost per share was like $44 from buying twice around here. But if you look at them now, I just added more into my position because I really have faith in the company. And I think that they've been unfairly beaten down due to the major sell-off in the retail industry. The one concern that is going to be facing all REITs, even the stable ones, is rising interest rates, because REITs are really a dividend play. And so in a rising interest rate environment, the dividends that the REIT pays out become slightly less appealing. But Realty Income has been very, very stable through other high interest rate periods, and I don't think that that's going to have a huge effect on them, especially since they've been sold off so much recently, and I really do think it is an unfair sell-off. So as you can see right now, they're trading right around support levels, which is nice. They've bounced off of this level pretty much 4 times, and it looks like they just started to bounce here. So I think that that means that the bottom for the price of Realty Income right now is going to be around $53 per share. I know if it drops down any more below 53, I'll be building into my position even more just because I have a lot of faith in this company. So I think this is a tremendous buying opportunity because they've been unfairly sold off due to the poor performance of other REITs in their sector. I know that there have been some other ones that have had clients that have been saying, oh, we might be going through bankruptcy soon, and that has affected the entire industry. But like I said, when we looked through the tenants that Realty Income has, all of these companies are extremely financially stable. If you look at a lot of the main ones like Walgreens, FedEx, they have low debt as a company, and their share price has been performing well recently. So I think that there's really very low risk that their clients are going to struggle. And the performance of the REIT is directly related to whether or not their clients can pay them. And I think Realty Income isn't going to have any problems with that in the near future or at any point, really, because I think it's managed well enough. So that I just wanted to make a video to share this opportunity that I saw with you guys. Please let me know what you guys think in the comments. Do you think that this is a good opportunity? Are you worried that Amazon might move into drugstores and that could affect Realty Income? Let me know in the comments below. If you guys have any videos that you want me to make, would you like me to analyze a certain company? Would you like me to make a video about a certain sector? Really anything, just ask in the comments below and I'll be happy to try and make a certain video that you would like to see. So just let me know. And remember to please like, subscribe, and thank you very much for watching.